there's been a revival of the bid for duration. And you think about the active debate that the market is having right now about the Fed's rate cutting trajectory. Does that bid into duration make sense at this juncture?
So there's a lot embedded in the question that you just asked me, so I think I'd like to unpack it and parse it. So I think the first thing is active versus passive. If you look over the last decade, the growth of active ETFs has been double that of passive ETFs. So I think the market has spoken loudly, and active is the way to go in fixed income. Why is that? You get the benefits of active management, so research, security selection, and portfolio construction. Then you also have the benefits of the ETF, so that daily liquidity, the intraday liquidity, and the pricing, and the transparency, being able to see what everybody owns on a daily basis. So we are big supporters of active ETFs. On the topic of duration, which is a completely separate topic, I think it's important to remember two things. Number one, we have a record high in the amount of money in money market funds. So broadly, the American consumer is massively underweight duration and has a lot of CDs, money markets, et cetera. So the move into duration makes a lot of sense because I think people are underweight duration. Now, what is that predicated on? You know, our view is that the U.S. economy is in a soft landing. So soft landing, the Fed has cut rates 50 basis points. And yes, there's an awful lot of debate about whether they're going to go in November, in December, next year, how many times. But I think broadly, the Fed has telegraphed that rates go lower from here. And that is a great backdrop for adding duration.
So you mentioned a couple of things. I want to pick up on one of them, which is active versus passive. 4 or 5 years ago, there was a lot of concern that active ETFs would give away the secret sauce of portfolio construction. There would be all these bandwagon investors jumping on, getting a free ride by mimicking the holdings. Has any of that come to pass?
I hate to say it, but good luck with that. The ETF that I run, 2,973 line items. If anyone here thinks that they can replicate that without the benefit of a global research platform, risk management, and everything else, they can have it. So yes, we publish daily what we own in our ETFs.
And you show it out there and no one's getting a free ride.
Yeah.
Let's talk about how active you need to be in, for example, the government bond space versus the corporate credit space, because much has been made about how tight corporate spreads are. Both of you look at high yield, if you take a look at investment grade, and we have seen hefty flows coming out of HYG, LQD, for example, this year. And a lot of people have pointed to those tight spreads and said this is a complacent market. But I'm curious, I mean, how your active managers are navigating in that space.
So a couple of things. If you believe the soft landing that I have articulated, then that's a great environment for corporate bonds, so investment grade and high yield, and also securitized credit. So I think that's the first point that I would make. In terms of the spread question, you're absolutely right. If you go look at high yield spreads, they are in about the 5th percentile, so very expensive versus history. However, if you look at yields, yields are actually about the median. So it's this whole yield versus spread. And when I think about investors, they don't eat spreads. You know, yield are what help people in retirement. And when you're looking at 7.5%, 8% yields there, you're looking at 5%, 5.5% in investment grade. It's hard to argue with those types of yields.